Hey, this is Geoff Gannon, and you're listening to the Focus Compounding Podcast, the podcast where Andrew and I talk general investing concepts. To get even more content from me and Andrew, sign up for the Focus Compounding app. The Focus Compounding app costs $7.95 a month. It comes with a bunch of 2,000-word articles from me each week, a fresh batch of 5-minute videos from the both of us, along with one bonus extra-long episode of the podcast each Saturday, and immediate access to our complete backlog of 200-plus episodes. To sign up, go to focuscompounding.com/app or wherever apps are sold. And now here's Andrew with your regularly scheduled podcast.
Welcome. How's everybody doing? Hope you are doing well. My name is Andrew Kuhn, Focus Compounding, sitting next to Geoff Gannon. Geoff, how's it going today?
It's going very well, Andrew. How's it going with you?
It is going great. We hope it's going great for everybody else as well. I forgot to set the timer, so I'm going to go ahead and do that right now, get that stopwatch going. In today's podcast, we're going to be doing a two-part series of a Q&A. Every Monday, for the most part, I tweet out a call for questions, and then we will take your questions and then answer them on the podcast. We get a ton of questions now, so what we decided to do is really just dedicate two podcasts to the Q&A, and what it really allows us to do is if we want to go deep on a topic, we can go deep, and we don't have to be so superficial about it. So first question that come across is, what is the minimum amount of info you need to know to appraise a business? And he says he's referring to Geoff's 2013 Guru Focus article on how to practice valuation. And you actually used to do blind valuations often, I remember. You had some posts and stuff like that. I did some
posts about blind valuation, to give you an idea of, to try to get people to look at, without knowing anything about the stock, how they would value it, given the earnings per share growth, the historical figures for the company, things like that. I think it depends on the company. Because there are ways, like with blind valuations, that you could fool someone if you're trying to trick them and get them to appraise it at a very high value or very low value, despite because they don't have all the facts. But for a lot of companies, I guess you would, to have it within a certain range of reasonableness, it would be probably less than you think if you have a lot of historical data. 1 year's data will not be very useful, though. I think people rely too much on 1 year's data. So thinking that just based on this year's EBITDA or something. But if you had 10 or 20 years of data, like you can get from QuickFS and things like that, I think that it might be less information about the business than you might think you need to know. Because I'll go through things where I'll look at all these banks and stuff, and you can kind of guess without knowing certain things about the bank's business model. How successful it is at things and stuff just from financial results if you have 20 years of financial results. So you don't need a lot of information about business if you have a long amount of financial results. You might need to know what industry it's in and things like that, obviously. Yeah.
And you have said before too, so even if you have 10 to 20 years of data, no matter what, if it's EBITDA, free cash flow, net income, you usually use a 3-year average as well too.
Yes, definitely. Yeah. I'd be most cautious about using too few recent years for a business. Yeah.
Got it. Next question. He says, I assume that options in general are less accessible to your strategy since most illiquid unknown stocks don't have option contracts written for them. However, what are your thoughts on long dated options, specifically calls or warrants to generate leverage / outsized returns?
We've talked sometimes about leaps. So they're talked about in the book, You Can Be a Stock Market Genius, and that would make sense for some big stocks you could do that in. I don't know about using it to generate bigger returns. I'm a little doubtful about that. I think it makes more sense to use it in stocks in which there's some reason why you think the chance that the stock could decline a lot under some scenarios within the period that the option is over, would be the ones that are most beneficial to you. So in other words, to reduce the amount of money that you put into the stock, you buy a smaller amount of options, a smaller dollar amount than you would in the stock, because you have some fear that it'll go under or something like that. So the example from You Can Be a Stock Market Genius is Wells Fargo. They were having problems with California real estate and stuff like that. That would make sense to me, more so than for a value investor, that you might want to do something like that, just because it's more similar to Buffett doing his convertible preferreds and things like that, which you can't do. So if there's some reason why you'd be cautious about the common stock, the reason why you would buy something like an option or a convertible or something like that that make more sense is if the common stock is attractive, but for some reason doesn't have as much downside protection as normal. The biggest difference between a common stock and other forms of securities usually is that for certain businesses, the common stock has a very low chance of going down close to zero. And because of that, it's very easy to pay too much for options and things versus the common stock if that is present, that protection. So if it's a very safe stock, you're likely to make a mistake by buying the options. However, if it's not a safe stock, it's possible that it might make sense. And so, like for instance, Buffett invested in convertible preferred and stuff in Gillette, and that's just not necessary. Buying the common stock would have been a perfectly good investment too. Whereas buying the convertible preferred into something like Solomon or something makes sense. Now, you're in a different position with options than convertible preferreds and stuff, so it sounds weird that I'm saying that, but the advantage can be similar because you could buy a lot less of it, and that's what I'm saying. So you could put 2% of your portfolio into something instead of 20% and get similar upside in some stocks by doing that, which is kind of like being higher up in the in seniority and stuff in terms of like how little you're risking of your investment. But I think usually not usually, all the time when people ask about it, they want to almost leverage returns even more and stuff that was already risky to begin with. So it's not something that we do.
And you really think about it from like a risk minimization standpoint then, basically.
Yeah, I mean, it makes sense to me that you might want to buy things like leaps in certain investments that almost seem like it would be too risky to buy into them because of something that hasn't been decided yet. Like the one that I mentioned was like Carnival with COVID, because the business will be worth something afterwards and stuff. But even with that, honestly, if you're going to do that, you could just buy the debt of Carnival, especially if you're like a professional investor and stuff. That would make a lot of sense, is to look into buying the debt instead.
Let's see. Next question. It says, Hidden Champions of the 21st Century distills research into strategy recommendations for companies that want to be like hidden champions. Do you agree with Herman Simon's conclusion about strategies? Is this type of thinking in your investment process?
No, not really. I don't usually agree with management books' conclusions on those things and stuff. And also, hidden champions for the most part don't have like amazing returns on equity or anything like that. They're fine, but as a group, they're not necessarily amazing businesses. They're resilient usually, and they do a good job in whatever little niche they're in. But I don't think it's necessarily something that I would suggest companies follow. No.
Next question. How do you decide to sell parts of a position because it becomes too big of a position in your portfolio? Say if you think the stock is still undervalued, do you still sell to keep position sizing? Thanks.
I mean, people do and stuff. Really, you shouldn't. I mean, there's not a lot more to say about that, except it's probably a mistake to do it. Everyone does it, and it's almost certainly a mistake mathematically. A devastating mistake mathematically.
Like a lot of people, if they put on like a 10% position and it goes to 20, they'll like pare it back to 10.
Yeah,
stuff
I'll
like
give you
that.
an example. So Amazon, I think, has returned about 30% a year for the last 20 years, something like that. So if you had bought Amazon and you had bought Amazon and 4 other companies at the same time, and all the other 4 companies went bankrupt, and Amazon you held on to this whole time, your returns over the 20-year period would be 20% a year on your full portfolio. Okay. So you would have only been decreased by 10% a year over the full 20 years from losing complete loss on 80% of your original portfolio. That only works because you kept letting it compound on that other part of your portfolio. What people will do is they'll cut back the sizing on that, and that will result in much worse returns. So the truth is you really shouldn't do that, but all professionals do it and would probably get fired if they didn't, not just from a risk perspective, but because of what would happen to their returns. Their returns would look really good in some years and then really terrible in other years, which is something they can't really do. I mean, you'd be up huge amounts, but for an individual, like following a coffee can portfolio perspective, it does make sense to just actually hold on with it, unless you're selling for a business reason. So that would make the most sense. But yeah, it's a problem that even we can have and stuff that way, that things can get oversized. And particularly it has a timing issue, I think, is one reason people don't do it, who are professionals, and even individuals, if you judge yourself year to year. But like an individual doesn't need to do that. There's no reason for you to calculate your annual returns. You don't need to do that. Instead, you could just calculate returns in each stock since the time you bought it. There's no reason to like use the calendar, you know?
When you say sell because of business reasons, you mean to buy another stock, or what do you mean by that?
No.
Just like if you need cash for something?
No. Just reasons like you think something's changed with the company that you don't like. So as an example, I gave the example of Amazon. There are plenty of times where Amazon would have been overpriced or something so that you might have wanted to sell because you're worried about the price. But there was never a point in the last 20 years where Amazon would have concerned you about a business. And there's lots of other stocks like that. We mentioned Activision. There's no point in the last 20 years or whatever where you have been concerned about Activision as a business enough to sell it. However, there are with other companies. And so there's plenty of examples where you might have invested in something and then decided I want to sell because something about the business has changed. Like I invested in Village Supermarket. After the first 10 years or so after I invested, some things had changed. Not that it was like super risky, but it no longer had a lot of path for growth. So you might want to sell for business reasons, not just price reasons.
Got it. Next question, thoughts on investing in liquidations? Have any experience with them? Any thoughts on, is it Luby's liquidation?
Yeah. I have invested in liquidations before, and let's see. One of the only times I've had a very large loss in a stock was in a liquidation that was planned and then didn't go through and stuff. So that does happen. Although if I did calculations on the annualized returns for all my investments in liquidations, they'd probably still be pretty good. But that's the experience that I've had in liquidations, just like merger arbitrage and stuff. It's kind of an odd experience because it's not a lot of fun to do it. And most people stop doing it, I'd say. But it's probably gives you better returns on average than other kinds of investing. The reason why people stop doing it is because you make a bunch of money on things just going through as expected. And then the only things that are different from what you expect are these big losses that you have. It's sort of like an insurance business or something. But yeah, I've done it. Other people I know have done it. I think returns are generally pretty good from it on an annualized basis. But most people who do it, I think, eventually stop. And one of my only very large losses in a stock was in a liquidation that didn't go through. It happened because there was no financing available for it and stuff because of the financial crisis.
Did you own the stock like pre-announcement of liquidation?
Nope.
And then it just went, oh God, so you
no.
did like
Bought
an arbitrage?
It for the liquidation and everything. And as long as they would have had bank financing, it would be almost 100% guaranteed they would have liquidated and stuff. It was all good for that. It's sort of like COVID. The same thing could have happened for COVID. So some companies like announced they were going to liquidate their stores or something for like bankruptcy type things. Now this wouldn't affect common shareholders, but it could have happened to debt holders. So you expected that it was going to happen, right? And then the stores got closed down, so it couldn't for a few months. Same sort of thing. It happened in something in the financial crisis where they couldn't obtain short-term financing for things. And so basically, you had disaster happen that way. But that's not unusual. Merger arbitrage stuff all fell apart when financing for that happens. So yeah, you have a couple that are huge losses.
Next question. Have you ever valued a business with 1, the customer-based method, or 2, the abnormal earnings method? Comps, DCF, others are appropriate for which types of businesses?
I don't know exactly those methods, I think. I don't know exactly what the abnormal earnings method is. And I'm not sure if I have used customer-based methods, but I don't know if it's exactly what he's talking about there. So things like the DCFs and stuff, the comps, DCFs, I've used DCFs in a couple cases. DCFs are most appropriate in cases, I would say, in which the company owns an asset with a long life left on it that it's depleting. So 2 ways in which I've used DCF things are where there's an existing customer base and you can use the DCF to value sort of how long the existing customers you'll lose them and how much cash flow you'll get off of them and things like that. And then the other reason for using it would be in cases where there's a finite lifespan that's very easy to measure and stuff. So I don't know if we talked about it on this podcast ever, but we talked about a cemetery company with Trey on, I forget if it was on his podcast, I talked about it, or on our podcast. But that you talked with him about it. But that would be one. I think I've written about Mills Music Trust on the website, Focus Compounding. That's copyrights that will be coming off over time for songs. And definitely, I have mentioned before, US Lime, which one of the reasons for doing a DCF is that compared to most natural resource companies, like an oil company, it owns an unusual amount of life left on its resources. So the reserve life is very long. So that's something that's important because, see, sometimes people will value a oil company on something like price to earnings or something, right? Or dividend yield.
Sure.
But if it only has 12 years left on its reserve life versus another company that has 100 years left, it becomes significant. And it becomes very significant if interest rates are low. So I would use it in cases like that. And, you say, okay, so if they have 60 million tons left and they're producing at about 1 million a year, then you use like a real rate and all that sort of thing. So yeah, DCFs are most appropriate in those cases.
He says, what's the downside value for NACO? And then should EBITDA minus CapEx be a better measure as it ignores working capital changes, which tend to even out over the long term?
I don't agree that working capital changes tend to even out over the long term. That's not really correct in my mind. I mean, unless they're asking specifically about NACO, in which working capital isn't very important. But working capital changes have to do with the process of a company moving through time. So usually for a company, you will have very different working capital changes depending on if the company is growing or shrinking and what kind of company it is. Some companies, as they grow, will use up a lot of working capital. I would just say that because you can look at companies like, I would say, look at IEH Corporation, IEHC, and try to look at EBITDA minus CapEx versus looking at what their growth in working capital has been over the last 10 years. Or look at Tandy, which is having to impair inventory and do a whole accounting review because of the same reason. Now flip that and look at things like Cheesecake Factory over the last 10 years. Before COVID, it was getting to use less and less working capital because of things that it was doing with how fast it was paying suppliers versus how fast it was paying its employees and things like that. It was generating more ability to tie up less working capital over time. That all reversed, of course, the moment that COVID happened, because it's something that through time is working that way. It's very important to understand this about working capital. Working capital is a time lag thing, one way or the other. So do you have to buy inventory on a speculative basis for your customers and hold it? If so, as you open up new stores and do all these things, you're not creating cash profits. So, and then you have the reverse situation, which the companies that are generating float and stuff like that. But you have to realize that if you have a company that generates float, like an ad agency or something, if something hits like COVID, that immediately reverses. The same thing with an insurance company. I've seen people look at insurance companies and think, oh, they generate a lot of float and everything. That's great. But if you're analyzing them at a time where they're worried about their underwriting, and so they suddenly cut back their premiums a lot, now the float's going to go in the opposite direction, because they have to get serious about that. And in fact, one of the problems that things like insurers have is that they can actually bring in more money today by just writing more business now. So it's actually a way of doing it. I mean, I think Geico did that in the 70s, that they thought, oh, we're having some problems, but if we write even more insurance, we can get out of those problems. We can bring in money today. So I think it's very important not to do that. I know a lot of people use EBITDA minus CapEx, and for the average business or whatever, does it work fine? Maybe. But the really interesting examples where I think value investors get it wrong are that the working capital changes are very favorable to the company. And so I think that, like, for decades, people undervalued ad agencies and stuff, or the opposite, the working capital changes are very unfavorable. I mentioned too, I think value investors could easily overvalue IEH Corporation and Tandy Leather, because if they were just focusing on things like EBITDA, I think that's not right. Yeah.
Mm-hmm. Do you think people use EBITDA minus CapEx a lot because it spits out a higher valuation, or?
It's also easier because you don't have to worry about the working capital changes where over a longer period of time you do. I mean, one way of doing the working capital thing, for instance, if you're saying does it tend to even out over the long term, you could just take 10 years of what is the average free cash flow margin and apply it to today's sales. Like that's an appropriate way of doing it. So saying, okay, on average, they've generated 5% of sales converting to free cash flow each year. If you take a 10-year average of that and you say, okay, it's 5%, and you multiply it by today's sales, you're getting a fairly accurate number. The other thing is I think you have to analyze a business on the basis of asking a question like, okay, do I think it'll keep growing at this rate? Or do I think it'll stop? And if it stops, what will the situation be? If it stops, you want the situation to be that it throws off a lot of free cash flow. And for a lot of businesses, that's true. If they really stopped growing, then they'd be generating a lot of free cash flow. But again, using an example like Tandy or something, if you look at the last 5 years or something, the quality of the growth and stuff could be seen to be not as good as it had been 10 or 15 years ago, in part if you analyze the cash flow statement. And, so I think that's a very important part of it. The quality of the earnings through looking at working capital changes.
Got it. Do you have anything on what's the downside value for NACO?
Well, NACO has some cash, right? And it has some debt. I would imagine that the cash in excess of the debt is a reasonable downside value for the company, certainly. It owns some other things too. Technically, the debt is non-recourse to the parent company and stuff. It would depend on whether they're willing to put money into businesses that are non-recourse, where the debt is non-recourse and stuff to them. So, I mean, they have cash, they have acreage of natural gas and stuff, so they have other things besides just the coal business that they have. But I don't know exactly what the downside value would be, no. But the stock can go way further down. I mean, the stock can do anything. So I would say on average, let's see, if you look at the price that is today versus what it is at the spinoff, like what its average in earnings over the spinoff, I guess it's trading at like 4 to 6 times its average earnings of that period. So if it can trade at 4 to 6 times, it can trade at 2 times. I mean, the stock can go anywhere. That's not a problem.
Got it. Cool. Well, I want to thank everybody so much for tuning in to the first part of the Q&A series. We'll pick it back up in the next episode that will be uploaded later in the week. I want to thank everybody so much for tuning in. Hit the subscribe buttons, and we will see you in the next podcast.